Hello everyone and welcome to the very first installment of our Multi-Manager Insight series for 2025 titled Future Pathways, Exploring Economic Changes and Investment Prospects. I'm Demisha Greater and it is my absolute pleasure to be your host for today. Now, in a world where economic dynamics are constantly shifting, staying ahead of the curve is crucial for investors. Today, we will be exploring the latest trends and developments in the global economy, offering a comprehensive overview of the opportunities and challenges that lie ahead. From geopolitical shifts to technological advancements, our speakers will delve into the factors shaping the future. Now, we have a fantastic lineup for you today, and over the next hour and a half, we will bring you insights from our industry experts from their respective fields. Our first speaker for today is Nikki Weimar. She is the Group Chief Economist at Nedbank. Nikki will be providing us with an economic update and sharing her insights on the current state of the global and local economy. Now, given the current backdrop painted by Nikki, we want to know, are emerging markets facing tailwinds or headwinds? We'll be speaking with Ian Beattie. He is the Managing Partner and Co-Chief Investment Officer at Ennis Partners, who manages the Ned Group Investments Emerging Market Equity Fund that is held across our fund of funds. He will delve into China's role in shaping the future of global emerging markets. And with the ever-changing investment landscape, finding the right opportunities goes hand in hand with partnering with the right manager that can adapt, innovate, and have a clear focus on the future. Delphine Govender, who is the co-founder and chief investment officer at Perpetua Investment Managers, speaks strategies for capitalizing on the evolving economic landscape. And then we conclude our session with a focus on South Africa's resilience and reform, addressing the country's economic challenges. Elias Masilela, he is the former Chief Executive of the PIC, former Deputy Director General at the National Treasury, and the former South African Reserve Bank board member. He has a wealth of knowledge and experience in economic policy and reform, and he'll be providing us with a comprehensive understanding of South Africa's economic landscape. Nikki, it's always a pleasure to have you with us. I know that for today's presentation you have the title as South Africa. The outlook is clouded by uncertainty. So before you go in, I actually just wanted to share a quote which is actually related to what you'll be sharing with us today. It's by Tony Robbins, and he says, "The quality of your life is directly related to how much uncertainty you can comfortably handle." So on that, maybe just give us a sense of how comfortably the global economic environment has been able to navigate this unpredictability. Over to you.
Hello, Julie. It's nice to see you again, and hello to the audience. Yes, so we are living in extremely uncertain times. There's no doubt about that. I think we all understand where the uncertainty is originating from. We've seen a very significant change in U.S. economic policy under the Trump administration, and it does seem like we are seeing a shift across the globe, and that is going to have ripple effects that will impact the world economy going forward. So what I thought we could do starting out today is just run through some of these key changes that are coming in. One of the first things that the second Trump administration has done is that it clearly seemed to have a different approach to geopolitical relationships and certainly foreign policy. And what we're kind of seeing at the moment is a geopolitical rearrangement. Under President Trump, it seems that America is really quite willing to shake up the global rules-based world order that they themselves put in place after the Second World War. And that has created for the world economy what we could call a peace dividend. Now, this peace dividend seems to be under threat at the moment. And part of the reason is that Donald Trump's interactions with the rest of the world appears to be very unpredictable and also goes against what the world have grown accustomed to. He seems to be very hard on his allies and seem to be a lot more open to what used to be really the US's adversaries, if you like, and much more open to negotiate with dictatorships, with countries that might have undermined the sovereignty of other nations, where that is a very clear departure from the environment that was in place for over 80 years. What is clear is that US foreign policy have become a lot more transactional. One of the key things Donald Trump keeps saying is that the US have been the loser from this global security arrangement and economic arrangement that they've put in place. It's hard to find the evidence of that, but nonetheless, that is his claim. He believes that the US have an immense amount of power, an immense amount of leverage, and he's clearly willing to use that against both foe and friend in order to secure or extract for the US what he believes to be a better arrangement. What is quite disturbing, though, is that where in the past the US used to really drive the protection and promotion of democracy, of human rights, of open and fair markets. This is clearly a departure from that. Under Donald Trump, it seems that policy will become more transactional, but at the same time, we are also looking at a situation where the US now seems to view this global order as a situation where it's pretty much a zero-sum game. If someone else is winning or getting a benefit out of a certain trade arrangement, then it must mean the US is losing. And so it is this zero-sum game mentality that is a very significant departure from the way the US used to view global trade and foreign relations. So that, I think, will have very significant ramifications, especially for Europe, with the US now being far more open to negotiating with Russia, far less willing necessarily to commit to NATO and to Article 5 of NATO, which would require the US to defend any NATO country that might be under threat or whose sovereignty might be under threat. And this has clearly rattled the world. And not just the world, the markets as well. Everybody is grappling with exactly what will this new world order look like as we go forward, and that creates a tremendous amount of uncertainty. At the same time, there's also a whole range of other economic policies that the second Trump administration has started with. The first and most controversial has obviously been the introduction of very significant tariffs and other protectionist measures, which is really disturbing global trade and could have very significant consequences. More inside the US, he's also obviously wanting to push for an extension to the tax cuts he brought in 2017. They will expire this year. He wants to extend them and broaden the scope of those tax cuts. In order to make that possible in a country who is also running a budget deficit of close to 6% of GDP and whose debt burden has already shot up to over 100% of GDP, he obviously has to find some significant savings in government expenditure. And from there, as you all know, you have the Department of Government Efficiency, or DOGE, that has been wreaking havoc, especially with the federal government. And we have seen already over 30,000 retrenchments as a result of those attempts to cut spending. Even so, it's a drop in the ocean. It is unlikely to result in a situation where he will reduce government spending in the US sufficiently to compensate for those tax cuts. So in all reality, the markets are pretty much pricing in the probability that the US budget deficit will remain at an unsustainable level and pretty large, and that US public debt will continue to rise. Then the more one of the more positive features is, of course, that Donald Trump has promised quite significant deregulation. We have seen during the Biden years in the US that red tape has increased dramatically, and companies and the markets were very excited about this prospects. But on that front, we haven't seen much action. It's really been all around DOGE and their activities with the aim of finding the savings in order to effect the tax cuts they so badly want to put through. So that's another key shift. And then the last one is, of course, much tighter immigration controls and deportations. This is in a country that really relies on migration to fill, especially those sorts of entry-level jobs up to your blue-collar type jobs. And it will affect certain sectors much more significantly than others: agriculture, construction, hospitality, travel, all of those sorts of sectors where you have a very high volume of labor that is needed, low-skilled labor that is needed to run those sorts of companies and industries. So it could also have very significant consequences. If we put it all together and we see how these things are playing, how these things will likely play out, a key outcome of this is, if you look at the tariffs and the other protectionist measures, is clearly it's going to push up inflation. And that's going to have implications for US monetary policy. And bear in mind that the US sets the risk-free rate in the market. So it's going to be elevating the risk-free rate in the market, which will have an implications for valuations across the board. And then at the same time, it also has a dampening effect on economic growth. That's one of the key consequences. On top of all of this, it's also the way in which it's being implemented. If you're coming with tariffs, we are not talking here about mild tariffs. We are talking here about very dramatic tariffs. We've already seen put in place a 25% tariff on steel and aluminium with no exemptions and no exclusions. So that's come in effect across the board, and that is a very steep tariff rate. It's not 2% or 3% or 5% or even 10%. It's very rough. On China, we've already seen the implementation first of a 10% tariff on all imports, later doubled up, adding another 10% also on all imports. In the meantime, the EU has already responded to the implementation of the tariffs on steel and aluminium. At the same time, China has responded. China has retaliated in a much more targeted manner. They have really gone and looked at the American map. They've looked at the red states in America, those who voted for Donald Trump. They've looked at the industries, and that is where they focus their tariffs. So on mining, on agricultural products, they have matched US tariffs. So we are in the midst of a tariff war. The other problem with it is it's got this on-off quality. Then it's on, then it's off, then it's delayed, then it's postponed. In that sort of environment, you're creating so much uncertainty that it's very difficult for businesses to plan. If your aim was to expand your operations and you were going to serve, say, a market overseas, you will now be thinking a little bit harder about that decision before you proceed, or you might postpone it until you have a better indication of the lay of the land and how trade policy will play out going forward. So it's also the uncertainty that is being created by the volatile nature in which these policies are being implemented. And then I think the most damaging part here is that they are promising reciprocal tariffs, right? And this will come into effect on the 2nd of April. Well, that's when we'll get some information of whether they will proceed with it. Now, reciprocal tariffs, by the mere fact that for over 80 years, the United States have promoted the notion of open markets, of free trade, it is true that US tariffs are much lower than most of their trading partners, except for the Eurozone, Canada, Mexico, and the UK. Which have very low tariffs as well. And so consequently, if they are going to match the tariffs that is imposed on their goods that they export to 186 countries, it is going to become an administrative nightmare. The economists did some calculations on this, and they concluded that you would be talking about 2.5 million different tax rates. And so that might undermine DOJ's effort, because you might have to re-employ a whole bunch of federal people just to run this elaborate tariff scheme. Nonetheless, it's the uncertainty that it creates. So if we look at what the key conclusions are, or key implications of this very dramatic change in global and geopolitical relationships, and also in US economic policy, the key conclusions are that we are probably looking at a situation where you will have much more sticky US and global inflation, which we in South Africa would obviously tend to import. You would also have US interest rates staying at a higher level for longer. As you may well be aware, yesterday was the FOMC meeting, and the US Fed had made the decision to hold. And this is the second time in the row that they have left US interest rates unchanged, and pointing to the upside risk to the inflation outlook, but they also point to the threat to economic growth in the US. They say that the risk of recession is increased. They don't believe that it is material yet, but it's certainly increased. And that will have a ripple effect into economic activity in the rest of the world. So the next major conclusion of the global world we find ourselves in now is that you're going to have much more unpredictability, greater volatility, increased uncertainty. So certainty is now the new scarcity, and that simply means that you're probably going to have companies very reluctant to undertake expansionary fixed investment, which is the key to faster economic growth, more employment creation, more income growth, and thereby more demand. And that will subdue global economic growth. And then, of course, the tariffs themselves tend to undermine global trade activity, which is a key input into most emerging markets and to the world economy. It makes up about global trade altogether makes up over 30% of global GDP. So it's a very significant contributor. And if those volumes are going to start coming down, then obviously that's going to affect world economic growth. So those are the key applications. We are looking at a world where essentially inflation is going to be higher. Your risk-free interest rate in the world economy will probably settle at a much higher level, and you're going to have softer or weaker global economic growth. And if it really spins out of control, we could even see a situation where the world economy could enter recession. Very similar to the kind of environment we saw in the 1970s, which is that sort of stagflation type environment. Now, that's not a positive environment. In that context, where is South Africa? Right? How are we shaping up? Well, we've had 2 tough years. In this graph here, you see the red line, that is the rand value of all goods and services produced in South Africa. That's GDP. That little green bar there, that is essentially your year-on-year growth rate on a quarterly basis. And you can see we have had a couple of quarters where we've at least registered some growth on a year-on-year basis. Our growth has been very stagnant, very slow, very patchy, and certainly not across the board and in all industries. And we've had 2 years where it's been pretty slow going. In 2024, we saw in the second half of the year that consumer spending finally started to turn up. If you look at that green line, that is personal consumption expenditure, that started to pick up. And the factors that were behind that is that real personal disposable income finally returned to growth. We've had 2 years of declines, relentless decline in personal disposable income. And around the second quarter of last year, it started to tick up again. That was sustained into the third quarter. We believe that that continued into the fourth quarter. And as income returned to growth, consumers started spending again. Now, what made the difference to real income? Well, the biggest factor, in our opinion, was just the rapid disinflation we saw. Inflation came all the way down, falling below the Reserve Bank's target range of 4.5%. Headline inflation currently at 3.2%. Even more powerful if you look at the breakdown of inflation. Essentially what you've got is a situation where fuel prices have gone into deflation, so on a year-on-year basis, fuel prices have been declining. That created space for consumers, eased the pressure on them, and then food inflation has slowed all the way down to 1.5% from over 14% in the space of about 12 months. So those made very significant differences to the consumer's real purchasing power, and we saw that come through in a greater willingness to spend. The other factor that helped us during the course of last year was, of course, that we saw interest rates starting to come down. The first cut came in September, then we had another cut of 25 basis points in November, and that was followed up by another 25 basis points in January. So far we've had a 75 basis point reduction in interest rates. And we know that that's significant. Listen, there is little doubt that inflation has fallen much faster than the Reserve Bank has cut interest rates. So if you're looking at real interest rates, they are still extremely high. So monetary policy is still tight. But in South Africa, there is a very significant degree of money illusion. In other words, South Africans focus on the nominal interest rate. And we know in our models that if you get one cut, people don't necessarily respond. If you get two cuts, they don't respond. But if you have 3 consecutive cuts, consumers start to look at the situation and say, well, this looks to us like it's permanent. Interest rates are not going to reverse course again. It is starting to come down. Their confidence start to grow. And even though real interest rates might still be quite high, they are more willing to go out there to borrow money and to spend more. So the 75 basis point cut we've seen so far has already made a difference. The question, of course, is where do we go from here? Let me take you one back again. On this, we do think inflation will remain quite contained. It's going to start rising. It's going to be rising off a low base. And essentially, the key factor there is we've seen a very rapid deceleration in goods inflation. Now in this world where suddenly you've got 25% tariffs being slapped on all over the place, the US initiating, other countries retaliating, you're going to be raising the cost of goods across the board. We're going to be importing that. So goods inflation is going to start edging up. There's little doubt about that. Food inflation is also going to start rising. We've seen that global food prices are edging up off a low base. The only positive here is that global oil prices are under pressure and they are falling, so they're countering that effect to some extent. And the other positive is a very surprising development is that the dollar, which you would have expected, given all the uncertainty out there, given that the dollar is viewed as a safe haven currency, the world's reserve currency, the dollar didn't actually strengthen under these circumstances. In fact, it came under pressure. And so most countries have seen their currencies hold up fairly well against the dollar. And that will also help to subdue the inflationary effect of all of these other negative developments. So inflation will edge up, but we don't think it's necessarily going to run out of control. Overall, we see inflation averaging 4% this year, which is still well below the Reserve Bank's target of 4.5%. Next year, it's going to be moving closer to 4.5%. We have it at 4.6% over the year as a whole, just slightly above where the Reserve Bank would want it. Now, later today, the Reserve Bank will obviously make its decision as to whether they will give you another rate cut. If they base it purely on fundamentals, The fact that inflation's come all the way down, it's hovering just above 3%, that if you look at the breakdown of the consumer basket, there isn't any sign of very significant upward pressure brewing in any of the products and services in the consumer price index. So there doesn't seem to be there doesn't seem to be a significant amount of upward pressure on prices in the basket at the moment. Everything seems to be pretty contained. If they focus on that, they should give you another 25 basis point cut. But we don't think they will focus on that. We think they will look forward. They will look at the brewing tariff war and the consequences of that for inflation going forward. They will also look at the fact that the rand remains pretty vulnerable, even though the dollar hasn't rallied in any significant way. There is still a threat that it could happen, and if it does happen, the rand could come under pressure, adding to inflationary pressure going forward. And then finally, they will look at the US Fed and the fact that the US Fed is being so cautious and that the US Fed has just kept rates unchanged. And they might think to themselves, in this kind of environment going forward, there is perhaps some merit in keeping a little bit of fat in the system, leaving interest rates at least a little bit higher for a little bit longer until we've got some certainty about how things will play out on the inflationary front. And so as a result, we think they're probably going to hold interest rates today. We think that they'll more likely cut once the Fed cuts again. And for us, that's going to be around July. And that's probably going to be the last interest rate cut consumers will get. Going forward, we think the consumer will carry this economy. They will help us achieve slightly faster growth this year. And what's going to help them is the fact that inflation is going to remain contained. They're going to be in the positive as far as real income is concerned. On top of that, you've got the real sort of boost coming through from the two-pot system. We know those withdrawals in the fourth quarter of last year probably exceeded about 80 billion. And remember, last year, the two-pot system only came into effect from September. So consumers had very little time to raid their own future savings. Now they're going to have a whole 12 months to raid their future savings. And that's probably going to also boost income and keep consumer spending going. So that's where we think the momentum will come this year. What we would like to see is an increase in fixed investment as well. That's another major source of demand that has been very weak. It ended last year on a negative note. During the course of last year, fixed investment declined quite sharply. If you look at that first graph there, I show you fixed investment by your major institutions, the private sector, state-owned enterprises, general government, and you can see all of them are very, very negative. All of them are under pressure. There isn't really any sign of any upward traction. But there is no doubt that this is what South Africa needs to move forward. If we want to be able to accommodate faster growth in domestic demand, without running into all sorts of supply constraints, without triggering the return of load shedding, without triggering all sorts of logistical bottlenecks that just drive up the cost of production, therefore push up inflation again, force the Reserve Bank to cut interest rates and slow the whole thing down, which is kind of the cycle we've been trapped in for over a decade. We really do need to focus on improving the supply capacity of this economy, and that requires infrastructure investment, and government has to lead that. And government has put aside, in both versions of the budget we've seen so far, additional funds for infrastructure spending, and they're hoping to grow that. That's what that second graph shows you. They want to spend about 350 billion per year over the next 3 years on expanding South Africa's infrastructure. It's badly needed. It is what will make the difference. It's what will lift economic growth. The key now is whether they can actually spend it, whether they can actually implement it. We remain doubtful about that. We do think government's got capacity issues when it comes to that. And so we do think fixed investment will slowly start to tick up, but not nearly fast enough to the extent that we require. So going forward this year, we face a very uncertain global economy that will pose downside risk to our economic outlook. But in the interim, we have a positive cycle for the consumer of rising real income, contained inflation, and slightly lower interest rates, plus the two-part system, which I don't think is a good thing, but nonetheless, it is adding to consumer spending power. And as a result, we see faster growth in consumer spending, lifting economic growth from 0.6% last year to 1.4% this year, and then up to 1.8% in 2026. So we're going to be moving over that 1% level, which is at least a step in the right direction.
Nikki, thank you so much for your time. Unfortunately, we'll have to leave it there, but as always, thank you so much for explaining these economic concepts and really just helping to make it very easy for us to understand. Of course, that was Nikki Weimar. She is the Group Chief Economist for Nedbank. My colleague Leandra Temmers caught up with Delphine Govender. She's the co-founder and Chief Investment Officer at Perpetua Investment Managers, and they spoke about a future-focused approach to investing. Let's have a look.
Good morning, everyone. My name is Leandra Temmers, and I am a multi-manager investment analyst at Nedgroup Investments. And today I'm joined by Delphine Govender, co-founder and CIO here at Perpetua Investment Managers. We'll be chatting about future-focused investing. Delphine, welcome, and thank you so much for hosting us at your lovely offices today.
Thank you, Leandra. It's a pleasure to have you here.
Now, to me, my colleague has done an introduction, and she has explained to us that there certainly is two sides to this future-focused coin. Mm-hmm. Now, before we delve into the investment aspects, I'd like to focus on the asset managers themselves. If you could share with us your journey at Perpetua and how diversity has influenced the way you've built the business as well as the investment team. Sure. Naturally, that leads into how the industry kind of addresses these issues, like addressing the UN SDG 5, which of course refers to gender equality. Mm-hmm. And I'm sure you have in your CFA Pink Book also experienced some areas where there could be room for more inclusion and greater inclusion.
Absolutely. And I think, so if you think of our endeavor, which is investments, ultimately it's always measured and assessed by its outcomes, which, as we all know, is investment performance and track record, because that ultimately is the holy grail. But in order to achieve that outcome, it really is about the ingredients that go into it. So this is the output and what are the inputs. And so in an investment firm, the inputs are really the recipe, and it's most commonly summarized or simplified into people, process, and philosophy in varying orders. And I think as we started and built our firm, which was already at a point in time back in 2012 when the investment industry in South Africa very much fully developed in terms of the number of players, etc., we had to look at each of those components of the recipe and really understand how are we going to be differentiated and how are we going to land with something that was a sustainable offering to deliver excellent investment outcomes. And so even in our philosophy, we really looked at something that was slightly differentiated from the typical value orientation, which is typically either deep value or quality, and we really picked a very much all-encompassing approach. But then critically we came to people, and I think people for us was not just about our identity in terms of the founders, but also about trying to understand in this industry, we really focus when we speak about people, given that they're the skill-based element of this knowledge-based industry, that they're all about the unashamed meritocracy. And when we think about meritocracy, ironically, we always think about it as though it's the opposite, or the other side of the coin would be diversity. We never really speak about diversity and meritocracy being commingled. And in fact, that's exactly what we believed is the case. We actually believe you cannot have a truly meritocratic investment team if you're not picking from the most diverse pool. And so in setting up our understanding of how we were going to deliver the best meritocracy, we thought it was essential to have the most diverse talent pool, whether it was gender, whether it was race, the typical social demographics of diversity, but also background, history. Where did you go to school? What did you study? We thought that those were all absolutely essential elements. Because ultimately, a diverse team, we think, leads to far better investment decision making and therefore far better investment outcomes. And so this has been just completely intrinsic in our journey as one of the elements that really was at inception how we thought about how meritocracy is actually delivered. And I think more broadly, then, if we kind of circle all the way up to the industry, and you spoke about some of the CFA initiatives. I fortunately, given this is something that is much more than just a Perpetua journey, but also my own personal journey, I really felt it was important to get involved at an industry level, both locally and globally, around how we influence this whole notion of diversity in senior decision making. And ultimately, you're really doing it for the best outcomes for clients. And so the whole issue is, why are there not, for example, more women, when we're speaking about gender equality, in the senior leadership decision making? And this is about the entire pipeline. Are there enough young women coming in? Do they know about the industry of investing? Are they joining the industry? Are they being given opportunities in the investment team? And then are they literally going up to the senior leadership levels? And so we, through CFA and my work there, and then as my participation in industry, really sat down to understand at every single step of the way, from awareness creation at school level or at university level, all the way to the top, which is really the top end of senior leadership. How did we increase the number of women that were represented so we had a more equal outcome? And the Pink Book is a fantastic example of the role modeling. We think a lot of women in their professional journey tend to not stay in, even though they have every element that should allow them to stay in, because they see a lack of role models at the top being women, people who look like them. And so they think this is an industry that is mainly not for women. And so the Pink Book was really an initiative to showcase and inspire women on their professional journey about the numbers of senior women that actually have kind of broken through the proverbial glass ceiling and are making an absolute impact on outcomes at a leadership level. And so we're hoping all these interventions over time will really start to correct what is currently a very unequal top end, and because we actually think ultimately it's in the interests of clients to have this outcome.
Sure. Thank you for that context. Now, moving on to the aspect of managing money, I think a good place to start is, how do you view future-focused investing? What does that mean to you? And how has Perpetua entrenched that into the way that you run money?
Yeah, such a great question. And ultimately, I think when we think of the notion of future-focused investing, it's really about understanding what is going to be sustainable. What is the most sustainable way of investing, such that whatever it is you're doing in the endeavor leads to lasting outcomes, whether it's the way you make investment decisions or what you invest in. And so at Perpetua, ultimately, if you think of what it is a money manager is entrusted with, you're entrusted with somebody's hard-earned savings, whether it's discretionary, whether it's compulsory as a retirement fund, or additional savings, and you're being told, invest this well. That's the implicit almost promise or request from the client. Invest this well. And well is almost, we've always taken it to mean as though it's just deliver good outcomes. So, but then we've had to go down and devolve it a little and say, well, what does it mean to invest well? And for us at Perpetua, we really see it as having three components. It means, do you think in a way, we call it think well, do you act well, and then do you do well? And this is now both for us as money managers, and then also the fact that the client is entrusting in us as a fiduciary over their money, and then we're entrusting that money to leadership of companies, in the investee companies. And so that whole journey of stewardship over these hard-earned savings, how is that taken care of? My sense is that up until the last several decades, investing well mainly just meant deliver a great financial outcome. Now, we don't necessarily want to stop doing that. Of course, that's still the number one aim. But what is the journey to that outcome? And is that outcome sustainable? So if we think of those notions of think well, act well, and do well, really think well is about the mission of the business, both of us as a firm. Are we really motivated and purpose-driven to behave in this way of investing well? And then is our investee company, is that board and management also, thinking in that way? Is that company motivated? The act is really about the leadership element. So is our firm, for example, set up in a way that is aligned from a governance perspective to deliver outcomes that are future focused, meaning they are sustainable for the future, as opposed to just doing well in a short period of time in a very opportunistic way. And then as the investee company as well, is their board established and their leadership really motivated to really act in a way that is aligned with all stakeholders, whether it's the investors, whether it's staff, and whether they are a good corporate citizen. And lastly, there's the whole notion of doing well. And doing well is both the products and the service offering, for example, that the investee company offers. Is it something that is harming society, or is it something that could help society? We're very mindful and we're very pragmatic that human beings are human beings, and ultimately what we're trying to understand is not trying to bring an ethical or moral lens to what it means to be future focused, but really trying to understand a sustainable lens. How is business sustainable? So in the doing well, is management running a business that is progressively becoming a better business? And are they on a path and on a journey to have actions that are aligned with this? And so for us, future-focused investing is really a sum of these elements, fleshing out in much more granular detail this notion of the promise of investing well. Can it be devolved into much more clear, focused elements that we can assess, and that when we attribute our decisions, we can attribute them to having made sound decisions on each of those elements.
Now, when we constructed this mandate, Delphine, we took many things into consideration, including the global target for reaching carbon neutrality by the middle of the century, which of course means that companies need to have credible net zero strategies, plans in place, glide paths in place. At Nedbank, of course, we've boldly moved on this agenda, where we've tried to align our portfolios to UN SDG 13, which of course is climate action. This has become a lot more meaningful for us at Nedbank. Now, I'd like to delve more into the future-focused mandate. And I think a question that will undoubtedly arise from investors is, how is the bespoke mandate that Perpetua is running for us different from your standard SA equity mandate? Now, of course, we envision that at the start of this project, that we envisioned that this offering would have a natural tilt towards companies that are more proactive. But how has that actually panned out in reality now that the fund has launched and since inception?
No, and great question. And I think it's particularly relevant, perhaps for a firm like ours that's already, really down a natural path in all our mandates of investing well.
Yes.
So how do we specifically almost deliver this within this mandate to differentiate? And I think that's vital to understand, because ultimately you would think that there shouldn't be that much difference. And I should actually concede that holistically and philosophically there is quite a strong similarity because of the natural way, and perhaps that's why we're so naturally suited. This was not as though there's another team that we had to kind of hand this mandate onto to say, now bear this in mind. It's very organic outcome from our general investment team and our investment approach, which I think is powerful because ultimately it shows very strong alignment. What we do need to do, however, is that we enhance elements. So a classic example would be first understanding our processes. So we've, from the inception of the firm, and although this has evolved over the last almost 13 years, we've always had an assessment about the sustainability elements of our investee companies. Now, we've been over time able to devolve those into ESG scores, and particularly an E, S, and G, which, as we know, stands for environmental, social, and governance, and then an overall ESG score. And then we do that both at the investee company level and then at the sector level. Understanding that different sectors and industries have different embedded ESG risks and outcomes. So one of the things that we were able to do in differentiating this fund was that we were able to be a little bit more strict on the almost cutoff for where we would typically include an ESG company. So, for example, in every single sector, we would rank the best ESG scorers down to the worst. Now, the worst might be just a relative score. It would be just, that, for example, in the platinum industry, we might rank Amplat's ESG above Northam. Now, in our typical funds, we might be indifferent that we would have Northam, which perhaps is more attractively priced in terms of a forecast return, but more risky at a higher weighting than in the future focused fund. Whereas in the future focused fund, because we have perhaps a higher lens on the ESG, we would have more amplats versus Northern.
Yes.
So this is an example of the differentiators, position sizing. We also, one of the elements of Perpetua's ESG approach is that we have included what we call a veto and governance. So every single company has to meet a minimum G score in order to be included in any of our portfolios. For the Future Focused Equity Fund, we also included a minimum score on E. So we now have a minimum E and a minimum G for the Future Focused Fund, which was very natural, to do. And so what that has resulted in, for example, us not owning two stocks, which we would own in our normal equity fund, being Sasol and PVC. We don't necessarily think that that is negative for outcomes. Simply, we're really focused because we already know that the stocks that we are including already meeting our return expectations for the product. It's really about then ticking all the boxes. And then lastly, I'd say the particularly good scoring businesses that have particularly solid future focus and sustainability elements, we own them to higher weighting on this fund. So a good example would be a company like Woolworths. We think Woolworths is very aligned on all elements, on E, S, and on G. And so Woolworths would have a higher exposure on this fund compared to our standard equity product.
Yeah, thank you for that, Delphine. I think the question that internally our sales team always asks, the future focus mandate does not have an exclusionary approach. So when you mentioned Sasol and PPC and not having those stocks, it's not by means of you excluding it from the get-go. It's because they do not meet the ESG, your internal ESG hurdle, and that's the reason that they're not included in the portfolio.
That's exactly correct. So, and just to flesh that out a little more, because it could sound as though, how does it differ from excluding and then a minimum score?
Yeah.
So remember, this is our scoring methodology. And the reason we have the scoring methodology is to first assess the baseline understanding of how that company does, both in absolute sense relative to our assessment, which is based on 9 objective criteria, and then relative to its peers in a similar industry. So how does it rank versus its peers? Our scoring methodology takes every single element from 1 to 5. And so when a company does not meet a minimum score, now for this fund and for our funds in general, we don't purchase it, for example, in our funds in general, if it's a minimum G score. For this fund, both a minimum E and a minimum G, as I mentioned. However, that's not where it ends. It's not as though it goes on the we won't invest pile because of the scores not being met. We then use that score as a basis for engagement with the company. And so in many instances, we've gone back to companies and we've said, these are the issues we have with your E elements, which is why we haven't invested, or why we're concerned about your scoring is so low, or G. And we then work with the companies and engage with them to see how they could increase our assessment of those scores by assessing the underlying issues, which then actually is the entire point of trying to build sustainable businesses. It's not just to exclude them fully because they are failures or they failed to meet your criteria, but actually to say, we're uncomfortable with where you're currently at. How can we work with you to improve our assessment of you? Do you understand? And we think that that's actually, if you think of the evolution of ESG investing and responsible investing generally, that's actually a much more effective and proactive way to go.
Yes.
But we have to, we have to have a starting point that says, what is your baseline? How do we feel about this? So that we can actually compare. Else you will just include everything in your portfolio as though everything is equal. And we think that that's not accurate.
Yeah. Now, Delphine, you've been in the industry for a fair amount of time and you've seen plenty of change. If you could share with us how the evolution of ESG data and reporting has taken shape and whether there's been a notable shift in management teams to focus on these sustainability megatrends, if you will.
Yeah, I mean, I'd say a massive evolution. So, which is great actually, which means that potentially a fund like this would have been much harder to, for example, to have launched the Future Focused Fund a decade ago. Yes. For a couple of reasons. Largely, it would have been hard to truly differentiate the science behind what it is that we're trying to do. We would have perhaps spoken much more generally about upweighting certain things without really having evidence to back why you were doing it. So if I just cast my eye back even to as little as a decade ago, let alone 15 years ago, when we spoke about ESG, It felt like it felt very much like a buzzword that you did to the portfolio. ESG really was represented more by, did you vote in the AGMs? It was more proxy voting, an element of engagement, but even then the engagement was really sitting in just management, management meetings, and almost all the assessment was largely very qualitative in terms of elements. Over the last decade, I'm pleased to say the biggest shift has been the amount of data that companies are now releasing that allows us, for example, to look at GHG emissions, that allows us to look at intensity of water use, that allows us to understand the true breakdown of the board. We can see exactly how decision-making powers exist at a board, whether it's governance. We can see, for example, on a social lens, what is the average wage, what is the wage gap between the top earners and the bottom end. That sort of data was just not available before. So we can really assess the underlying ability of the culture of this company to being managed in a sustainable and responsible way. So the beauty is that if I mentioned our scorecard, which has about 9 elements to it. 10 years ago, almost all 9 elements were qualitatively determined. Now, more than 6 or 7 of those elements are actually completely quantitatively determined, because we now have that data. And I think the fantastic thing for me, as I see with engaging with companies over the last 27 years of investing, is that a lot of this stuff used to be this general conversation and very intangible almost when we spoke about working conditions for employees. Now we can actually have direct conversations, and companies have become significantly more proactive on engaging with investors in advance to say, we're thinking of doing this as an example. How do you think this lands from an investment perspective? Do you think this is smart stewardship? And in fact, now that we've had ongoing engagement and there's been a back and forth dialogue between companies, they now have a much clearer understanding of what it means to be actually adopting policy. So there should be very little almost shock elements, whether it's in the REM policies, whether it's in environmental focus areas. We've seen a huge evolution in companies saying we now can have an ability to understand and locate how capital allocators think about what are the policies they will allocate capital to, and what are the policies which are poor they will deprive capital from. And so they're behaving much more proactively. And so I think ultimately the state we're in, by all means, this is a journey. You're not going to arrive fully. And ultimately what we would love to get to a point is that as we start showing you the performance of this fund, we'll be able to attribute the performance to elements of these aspects that I'm talking about, as opposed to, because at the moment it's still quite hard to say, except when a company fails, that this performance was attributed to this decision making. But over time, I guess we'll be able to compare the mandates that don't have this lens and the mandates that do, and hopefully we will see that edge being reflected.
Well, it sounds like managers definitely they're more equipped to be tracking these metrics, which is very encouraging. An area of headlines, though, that's difficult to avoid is the diversion of regulation in Europe and the US at the moment. Now, locally, I recently read a headline about the FSCA's renewed focus on ESG and transformation in the retirement fund space in SA. Now, I'm curious to get your sense of where you see regulation in the industry going locally in SA.
Leandra, it's always a vexed topic, because on one hand, you would hope that this journey of investing well and investing responsibility, investing for sustainable outcomes is something that we should just naturally and organically just adopt. But in truth, and as you think of that same value chain I mentioned, the money actually starts with the saver. And the saver is typically represented, if it's in a retirement fund, by a board of trustees and an investment committee. If it's in a mutual fund, by the underlying fund itself and the manco, and then it goes all the way down through the value chain to the investee company. Now, what happens is typically that responsibility for making that decision to invest well has typically been devolved through the value chain. So it's the fund manager, you're talking to me, for example, that is the one that mainly makes the decision. And then we sort of report back to the asset owner of the money, the saver. I think what's changing is the FSCA, who really is governing, who's the regulator for the industry as a whole, particularly including overseeing, for example, Regulation 28, etc. They're now telling the asset owners, or they're trying to get the asset owners to understand their responsibility in these decisions. So not dissimilar to this fund that Ned Group has conceived and launched, where you've taken on as almost the custodian on behalf of your client's money, the depth of thought about how to think about these things. And then you've gone and sought out the fund managers that can deliver this, rather than just handing it out and telling the fund managers, whoever can meet these. So we're starting to see that the FSCA is telling funds, we've tried to go the route of you voluntarily abiding by these things that we think will make for good outcomes. We're now seeing that not everybody is aligned. And a decade in, 15 years in, bearing in mind we have the PRI, which is the Principles for Responsible Investing, which has both asset owners and fund managers as signatories. We have CRESA, which is the local South African responsible investing code. We've got all these codes, but they can sometimes tend to be voluntarily met, which means that you have an industry where everyone's at a different point. And I think we need to almost converge. The term often globally is called taxonomy, where everything starts to converge because it can become quite complicated. And so I'm not surprised that there's an element of almost legislation that is starting to come, mainly to try and force almost alignment. Because if you allow things to happen too voluntarily, it takes too long, and you have very kind of almost mismatched approaches. So ideally, one would hope that there should not be, regulation to force things, but perhaps it's just an interim step to get mandatory disclosure. And my understanding, for example, on the transformation element is mandatory completion of a baseline understanding. Where are all the funds? Where are all the investors right now about how they think about ESG and how they think about transformation? Because then we can get a sense for the state of play.
Now, probably the easiest, but also the toughest question for today is, what is your hope for the Future Focused Equity Fund?
Yeah, I mean, I think it is the $1 million question, and to be honest, it is the simplest question to answer. The thing that we really loved about this fund, and we do love about it, is its holistic approach. You've gone as Nev Group Investments to really look holistically. You've thought carefully about what it is that you're trying to achieve in the end game, starting mainly with great investment returns, and then you've gone at every level. The way the fund has been put together, the fund manager choice, who's managing the money. Are they intrinsically truly motivated by this? And then how are they deploying it in the investments they choose? And are they having any ability to influence the ultimate outcomes? So it's really a holistic approach. It wasn't just this ESG fund. It's not just an RI fund. It really has gone, I think, a level higher. That's gone very thoughtfully to embrace it all. Now, the irony is that my hope for it is that it starts to almost become its own worst enemy, and that it makes itself redundant because the whole world starts to converge to the future-focused way of investing. And so I think the future-focused fund actually has been a bit of a trailblazer in pursuing this holistic approach. But I think that in time, our hope is that it shows that it is a superior way of investing, both in terms of returns and in terms of impact, such that you actually start getting copied. And so as we know, investments is a game of imitation, and perhaps it was necessary for someone to take the lead, and that the rest of the general equity funds start to see that this is actually a superior way of investing long term.
Absolutely, I can't concur more with you. As my boss Trevor Garvin would say, from your lips to God's ears. So, Delphine, the past 20 minutes have absolutely flown by. I could chat to you for hours about this topic. You're so passionate. But thank you so much for joining us today and sharing your insights on what future-focused investing means to you.
It's been a pleasure, Leandra. Thank you.
Joining us now is Ian Beattie, and we're going to be talking about all things emerging markets. But if you'll remember, the emergence of DeepSeek certainly has been seen as a game changer, and the startup was, I think, basically on everybody's lips, and this definitely has bolstered, investor confidence within the Chinese economy or the Chinese investment case. But I think some questions, that we still have. Firstly, is AI just the only thing that China will be hinging on? And secondly, are we starting to see China finally relinquish its claim as the ugly step EM sister? Well, to give us a bit more context around this, we're joined by Ian. Ian, again, lovely to have you.
Yeah, no, I think you've identified it exactly right, the really big catalyst there to me. But I mean, let's just go back one step. to get it in the context, China was hated, wasn't it? It was really hated. I mean, all we had that we could say for it was that it was cheap, but it was ravaged by deflation. There was a Cold War getting nastier. The geopolitics was terrible. There was a housing crash. There really wasn't a lot going for it other than it was cheap. And now, as you say, well, even before that, actually, even before the catalyst of a couple of months ago with DeepSeek, we saw the property market start to stabilize a little. Now, I'm not saying it was getting better, but it was stabilizing, especially in tier 1 and tier 2 cities. The government was trying to boost the consumer, not hugely, but significantly, and that was starting to get some traction. And then we have Trump, and Trump has gone about bullying his weaker neighbors rather than attacking probably who everybody thought he would attack first of all. In fact, there's even chat that, you know, there's going to be a meeting between Xi and Trump, and we all know Trump likes to do a deal, and there's certainly plenty of money to be made. So that was the setup. And then, as you say to me, along came DeepSeek. And DeepSeek was, as you say, a total game changer. First of all, I think DeepSeek reminded us that China is not that far behind the US in terms of AI and other advanced technologies. It's everybody else who is so far behind those two. And I think, you know, I remember talking in South Africa quite a few years ago now, where I got a chart up of all the patents or all the dollars spent on AI and the like. And it was actually, I had to put the US and China on a different scale to every other country, even if we added all the other countries together. It's that far ahead. Secondly, you know, I've got to say, who'd have thought the Chinese would have come up with a solution that was almost as good as the US one, but at a fraction of the cost? They've done it again. So it's not just manufacturing products, but also now AI, which of course is actually, or has been, quite a capital intensive process up until now. And thirdly, and this is really important in a China context, and I'm not sure everybody quite gets this, and that's that this is a private sector initiative, but now the state and the private sector have got behind it within China. And I think it's brought home to the leadership in Beijing that the private sector, you know, they can come through, and they have come through for the country, and they've changed the game. So I think that's really important. Immediately, there was a photo opportunity, which actually bore an uncanny resemblance to the inauguration in the US, where all the tech bros and a few others were photographed, you know, being so close to the president. Here we have Mr. Xi, the president, as well as a number of other titles, shaking hands with the Chinese equivalent, or the tech bros in China. And of course, that meant Jack Ma, the founder of Alibaba, was back. So as everybody was shouting, Jack is back. But it wasn't just him, it was all the other tech bros, well, most of the other tech bros and a few other big industrial leaders were in that room with Mr. Xi as well. That's a hugely important signal, because the market sentiment was that Mr. Xi doesn't have the private sector's back. He was only interested in the state-owned companies. Now, I think his priorities are still where they were, but it does show that he's willing to back the private sector on some things. He's not just anti. And so that has led to this massive improvement in animal spirits and a massive bull market starting to happen in China. And China's gone from being the worst performing market in the world to one of the best, and is now outpacing the US on a shorter term time frame. So it is very, very important. I mean, this DeepSeek democratizes, yeah, maybe that's a bit of an inappropriate word to use, commoditizes would probably be a better word, AI, and brings it down. You know, we're going to see a huge surge in AI applications now, or AI in applications, because of this commodification, you know, a cheaper price coming in, and you know, effectively democratization of this technology. So many more people, firms, and uses are now available. And one of the things, of course, that surged straight away is robotics. Whether it's a clever lawnmower or a guide dog or something that looks like out of a sci-fi film of a humanoid robot, these are all going to happen much more quickly now. In fact, I'm seeing, and I've been seeing firms working in humanoid robotics both today and yesterday. I'm in Hong Kong now, but I was in Shenzhen earlier this week and going to be in Guangzhou over the weekend, seeing these firms that are developing this. In fact, when you look at the component makers to make a humanoid robot, and yes, they do look like something out of a sci-fi film, you're seeing mainly US and Chinese firms. And of course, when you turn something into a manufactured product, guess what? Northeast Asia comes out on top again because they can just do it cheaper. So this is going to be a very, very interesting area. US may be still getting the higher value add areas, but you know, China and Northeast Asia coming in very quick with other component makers in this supply chain. And I think we're going to see these incredibly quickly. We're going to see humanoid robots. We're going to see hands that are fully articulating, and you know, better and better vision and LiDAR. Just seeing a maker of LiDAR today, it's not just going to be in lawnmowers and ADAS in your vehicle for safety. You can combine it with a camera, and it's going to go into a lot of other technologies. So yeah, very, very exciting. We're going to see more self-driving and more ADAS as well, because AI really is an accelerant into a number of these areas. So yeah, I think China's definitely back. There are still issues. I'm not saying everything now is fine. Emerging markets are back. There's a number of other positives. You know, there's an upside risk here as well on the state of the global economy, that maybe we'll come on to a little bit later on. But yeah, for sure, there's major changes afoot. And I think the biggest one is it's a wake-up call. China, emerging markets weren't as bad as people thought. They weren't out of this technological race. In fact, they're more advanced in other areas. And as the US economy looks like it's going to slow quite dramatically, and the Trump administration are not doing anything to disabuse us of that notion, then you know, we're seeing flows move around the world in equities and bonds quite rapidly. China's bond market was in a bull market. You know, the bulls in China were in the bond market during this deflation. That's backed off. Those yields have risen a little bit because the economy does not look so bad now. And it's equities that have surged. So are we at a turning point? Yeah, maybe we are. Has it gone a bit too far, too fast? I'm not so sure. But yeah, definitely there's a huge change in the mood here at the moment.
Ian, maybe let me come in there because you say that we could possibly be at a turning point. I think in the beginning I asked you the question whether there are more tailwinds for China or the emerging market basket as a whole versus some of the headwinds. Given you know the President Trump's policies with regards to tariffs, etc., how is this likely to shape up for emerging markets and especially for the likes of China? How would this be something positive for for that part of the world?
I think when you're looking at unpredictability, which obviously springs to mind when we're talking about Mr. Trump, that's his stock in trade is unpredictability. I think we have to be careful of what we are sure about and what the probabilities of forecasts are. So as soon as we start talking about this, I think my conviction in what I'm going to say does come down a little. We don't know what Trump's going to do in the next few hours, let alone what he's going to do over the next couple of years. He's obviously in a hurry, and he's obviously attacking other countries first. Like I said, he's bullying his weaker near neighbors first. The tariffs with China actually seem to be a little bit more measured and calibrated, and China's retaliation has been quite measured and calibrated as well. So we've got to wonder whether there is a deal brewing, and both sides don't want to get into a place where they can't come back from. That's what it looks like. It could change, but this is what it looks like to most observers at the moment. There is also the tail risk, the upside tail risk of a Mar-a-Lago Accord, or at least a currency realignment. Now, we've written on this. I think actually it's a risky maneuver, the way it's being espoused by the economic advisor to the US government. And I have a lot of problems with it. But most of those problems are with the US, or the risks to the US and the Treasury market and the dollar. They could actually all be positive to emerging markets, and certainly emerging market equities. So I've got a checklist of things to look at for emerging markets and for tailwinds that I usually run through. I think a few months ago it looked negative, then it became mixed, and at the moment it's starting to look more and more positive. Our checklist is look at real money growth, whether emerging markets are running stronger than developed markets, and that looks like that's starting to go positive. Global excess money is running faster than industrial production. Valuations are cheap. The global cycle looks like it's firming slightly if you look forward. Commodity prices you could argue are firming, and the US dollar may have peaked. All of those are positive for emerging markets. Those are all the tailwinds, to use the terms that you were using. So the only one I've got there that's a slight negative is that the earnings picture in emerging markets is not as good as in developed markets at the moment. So that's the only one I've got on my checklist that could be argued to be negative. So it's definitely a much better picture than it was looking before. I think the key thing to watch is the US dollar and the US Treasury market as well, because they're going to give us an insight as to what's happening in the US, what's happening to liquidity, and what's happening to the risk premium. Emerging markets are not going to be able to go against a massive risk-off environment. However, if the US bull market is over for a while, which is a big if the US Treasury remains okay, despite the massive funding that they've got to do in 2025, the US has to refinance a huge amount of its deficit. So therefore, you could argue that a slower economy and lower rates might be exactly what they want. And a weaker US dollar, that are the ingredients that you need for emerging markets to outperform. And you need some stories, but we've got stories in India, we've got stories even in South America, maybe with some political developments going forward, because they're pretty grim on the politics side there at the moment. Eastern Europe's catching a bid as well, as there's a growth story there and a positively shaped yield curve for the first time in ages. China still has its deflation issue. There are still issues, but if there's a deal to be done, if Trump wants a currency realignment, emerging markets are a major beneficiary, and China being the most hated of all in particular.
Ian, maybe give us a sense of what it is that, I think people or investors may be missing. So you see a lot of the headlines that come out of China, as you said, it has been hated, again, being seen as the stepchild. And you've given us some of the checklists of the things that actually are looking positive when we're looking at the cold, hard numbers. But you being on the ground, what are maybe some of the nuances that we are not aware of? What's the sentiment like? Some of those things can be missed if everybody's just looking at, the headlines based on what's being reported.
Yeah, I think there's two major points that we've got two major issues we've really got to come to grips with and have a view on. Then there's the harder ones that I'm not even going to pretend to come a view on. We'll just see how they develop. And the harder one is the geopolitics, the Cold War scenario. Are we actually going to get a hiatus in the Cold War because Trump wants to do a deal? Okay, so that's a big change from where we probably were, especially under the previous administration. And then the other important issues we've got to get to grips with is China still going to be in deflation? If it is, then that's a much harder investment climate for equities. And I think that's an important one. We've got chip availability that may be a constraint as well for their technological development. But secondly, so we've also got the fact that there are some great companies in China. So when you come here and you visit them, you see some marvelous companies that are taking market share globally, really run their businesses very well, have no debt. Okay, I think that's what people miss. Yes, there's a lot of debt in China, but it's not with the sort of companies that we invest in. None of the companies that I invest in have any debt in China. They don't trust the banks either. In fact, I spoke to a company today that when one of the other investors that I was sitting next to said, "Why don't you take on more debt?" She said, "Why would why would I want to trust the banks to go and borrow more or from them? You know, they don't trust the local banks either, right? Because they're state owned. So, you know, these companies, they run really good business models. They make very, very good money. They have excellent balance sheets. They have usually excellent, I mean, most of them have excellent working capital. Some have very poor working capital. So that's what you have to watch when you're looking at these companies in China. But these are good companies. So if there's a catalyst and you start getting some earnings upgrades again, and we've stopped getting downgrades in China and started to see the odd upgrade, but it's still a very murky picture that could change quite quickly. You know, there are good companies here that are worth investing in, even in things like, you know, household appliances or the internet companies. Obviously, Alibaba and Tencent have been the must-owns over the last few months, but you know, Midea and other great companies are out there as well. BYD has been the big performer in EV manufacturers as it launches another low-cost car. And it's very interesting to see their share price doing well while Tesla's does very badly. But there's all the supply chains to these companies as well. And then on top of that, as you said right at the beginning, is that you've got this DeepSeek moment. And that is a catalyst for change. That is seeing a spark in investment and in new industries suddenly, you know, getting, you know, scaling up possibly very, very quickly. So that's the exciting thing on the ground. But you don't neglect the fact that we've got some great companies that have been sitting here all along making good money, but nobody wanted to buy their shares. So you've got both sets of, you know, the new exciting opportunities. You've also got the good solid companies that were here all along, and now suddenly foreigners want to buy them again, and the locals are buying them again. And so you've just got that different mood music.
Ian, we've spent quite a fair amount looking at China, but I'd like to look at the entire emerging market basket or the opportunities that exist there. So apart from China, where would you say are other, you know, bright spots, or who the front runners are? And are we seeing a lot of the interest in emerging markets now concentrated around the artificial intelligence space, or are there other sectors that perhaps are untapped that you have been seeing or looking at and thinking it's quite interesting?
Yeah, well, it varies depending on where you're looking. I think we are seeing the AI theme flow into other areas. So, for instance, it was AI hardware, and that was the US, and that was Taiwan. And now maybe with this DeepSeek moment, it's a reminder to look at where it's going, what software and technology and firms it's now empowering and unleashing. That doesn't mean we forget perhaps about the hardware side, but definitely the marginal dollar is going into the robotics and the software and the people who are going to use this, and it's going to empower them in their businesses. Hence Alibaba doing very, very well. Hence the robotics names, hence the software names starting to lead the rally. And that's again, excuse me, again, that's mainly Asia, but maybe less Taiwan and more other countries, more China, for instance. So outside those areas in emerging markets, South America looks very, very interesting. There's some great companies there. Some of those economies have great potential. The politics has been getting in the way. If we see a change in the political risk premium, those markets will fly, and they've got cheap. So we're still underweight, but we're looking for opportunities to add to those, perhaps sometime over the next quarter or two. We're starting to get excited, starting to get very interested again. The Middle East also, there's some great structural change going on, some good companies. You know, we're not exactly buying them at peak oil prices, are we? So that's got to be good. And then when we go around to India, India's been one of my favorite long-term markets. We've had a big overweight there. We've made really, you know, really good money in India. We've gone underweight, our biggest underweight for many, many years in India. The market has pulled back. I must admit, I'm getting interested in again. You know, the central bank is starting to talk about easing. The government is starting to talk about loosening conditions again. I don't want to go back in too early, but I'm definitely seeing the companies there again, finding some exciting names. We'll probably start to look to accumulate India. I just want to check a little bit more data over the next month or two. But again, it's looking very exciting It's the long-term story in India is still there. It's just that almost the opposite of China. A lot of the what was very positive had just clicked over into negatives in terms of earnings, in terms of money supply, in terms of ownership and flows, and of course valuations are expensive. So all of those led to that market pulling back. I think some of those are kind of go to about neutral now. Valuations are a little bit more into the normal range. They're not cheap, but they are back down to a normal premium that India often has commanded. Just want to check a few things on the mutual fund flows, make sure we haven't damaged the animal spirits of the domestic investors, and maybe want to make sure that we're going to get some good earnings again. We've had a pretty poor earnings season now, two earnings seasons in a row, but all of those things seem a bit more cyclical to me rather than structural. So itching to get back into India again as well. So it's really very, very exciting. ASEAN has been really positive for us, and yeah. I think there's really exciting places to look at, like Malaysia, for instance. We've seen Malaysian government officials. We went on a trip through the new special economic zone, Johor, Singapore. That's opening up. They've been talking about it for decades. I've almost got bored listening to them talk about this, but we went there on the ground a couple of weeks ago. It's really happening. That's a really exciting, real, genuine, structural, on the ground change that's happening as Johor opens itself up to Singapore, Johor being a province of Malaysia, so a state of Malaysia. So that's really, really exciting. Very, very exciting indeed.
Ian, thank you so much for your insights. We certainly will be watching this space, and I'm sure you've had a lot of questions and interests around when emerging markets will be making their comeback. So we'll continue to watch that data, and we'll see how that transpires. Thank you so much for your time, Ian. Very much appreciated. That was Ian Beattie, and he is one of the partners from Ennis Partners, and they currently run our Net Group Investments Emerging Market Fund.
Thanks, Timmy.
Finally, we certainly are honoured to have Elias Masilela. Elias is the former Chief Executive of the PIC, former Deputy Director General at the National Treasury, and the former South African Reserve Bank board member. He is currently an economist at DNA Economics, and we hope that he'll be able to take us into his confidence and share with us his thoughts on building South Africa's resilience and reform, and of course addressing the country's economic challenges. Elias, thank you so much for your time once again. Elias, I just want to go back to around 2018. The World Economic Forum, or IMF, used to release what they called the CEO survey, and one of the things that they looked at was what keeps CEOs awake at night. You've obviously held very many positions, from being at National Treasury, from being on the PIC. Just want for you to perhaps take us into your confidence and to get a sense of what really keeps you awake at night.
I haven't been a CEO in a long time, but my sense is that whether you're a CEO or a sweeper in a business, there's a set of objectives that drive you. What makes a difference between the CEO and the sweeper is that the CEO has to worry about capital allocation and worry about time and worry about people as well. Where else the sweeper needs to worry about her time or his time. So the most important thing that the CEO needs to focus on is what the promise has been made to stakeholders. And stakeholders in this case, for me, starts with clients or customers, the community within you operate, as well as your shareholders. But we've seen increasingly over time that even though you start off with a very focused objective of meeting a particular demand at the right time, with the right quality, regulatory obligations have become extremely, extremely important. They take up a lot of time of most CEOs On average, a CEO will spend about 30% to 40% of their time worrying about regulation. And the rest of the time, they'll worry about running the business and making sure that it delivers. But of course, each business, each sector is different. But underlying all that are those principles that will drive CEOs.
Elias, you're speaking about some of the, the challenges that obviously a person in leadership has to deal with. Maybe take us back to your trip to Davos earlier on this year. Again, it was at the World Economic Forum. It came at a time when, the global economy is at a very interesting point. Can you maybe give us a sense of the tone at the World Economic Forum this year, especially given all of the geopolitical tensions that are currently going on? Give us a sense of what your key takeaway was.
The mood was varied. It depended on the day at which you are testing it or you're testing for it. But what was very clear is that there was an acknowledgement of the fact that we're meeting at a time where the world is facing its highest level of uncertainty for a number of reasons. And as a result of that, the first 2.5 days, I think, were about how do we manage this uncertainty? How do we improve certainty going forward? And globalization, cooperation, and partnership was at the top of the agenda in the first 2.5 days. That changed completely when the president of the US showed up on the screen. What was a united gathering until he showed up ended up being a grossly fragmented organization or gathering after that. So that tells you the amount of risk we're faced with. And it's so unfortunate that it originates from almost a single source. Yes, there may be geo uncertainty in other parts of the world, like in the Russia environment, in the Israeli areas. But I think those sources of uncertainty do not compete with what was signified when the president of the US showed up on the screen.
So it's very clear, and we're getting a sense of, the reception or the type of impact that President Trump had. How was, I suppose, South Africa received by the rest of the investor community? Knowing that you have been obviously frequenting, these big stages for quite some time, have you seen any changes with regards to this year versus prior? And perhaps maybe is this a time that South Africa starts to really take note of ensuring that we're a bit more maybe diplomatic or pragmatic in our approach to some sensitive issues?
Look, I think partnerships are informed by what you do first and foremost. If you perform well as a country, when you go to that forum, you're going to be well received and respected. And the reverse is true. It was almost painted clearly on the canvas before we left that this year the reception will be different compared to the last World Economic Forum, which was during the height of our power crisis. And in that period, it seems like South Africa had the roughest reception at the World Economic Forum. This year was totally different. I didn't attend the last one, but this year was totally different. It was well embraced. The president was well received. His speech was well received. So it shows you that your performance will inform what other people or how other people position themselves relative to you. And I think because South Africa has almost signified a shift away from a dark economy as a result of Eskom to an economy that gives promises. Everybody would like to be part of promises, or at least positive promises.
Have we damaged our reputation when it comes to being able to fulfill those promises?
We've had a lot of own goals, which I presume by now we all accept. But there's also been exogenous factors that have affected us. And I don't worry too much about the exogenous factors because there's little you can do about them. If people like you, if people want to do trade with you, or they don't like you and don't want to do trade with you, there's very little control you have of that. But what you have control over is what you do to the domestic, or about the domestic economy. And I think post-1994, immediately post-1994, and with the crafting of the National Development Plan, the objective was to build a resilient economy, an economy that can withstand even the biggest negative or exogenous factors that are likely to hit us. But I think we missed the boat there. We haven't been able to develop a resilient economy. And this is why even a small decision about the withdrawal of aid has the impact it has on the South African economy. And part of it is informed by the fact that, and for me, I see this as a litmus test. The number of people who rely on grant assistance from government tells you the extent to which we've performed as a country. The more of those you have, it means we haven't done well. And the reverse is true. And we should have an objective as a country to reduce the number of people who are relying on grant assistance from government. It is not right, it is unsustainable. It destroys the dignity of citizens. I don't think anybody will stand up and celebrate that they are grant recipient.
Elias, you mentioned that obviously we don't have control over the exogenous factors, and it's the endogenous factors that we can have some control over. You've obviously worked in the public sector and in the private sector, so you have a wealth of knowledge, having been in both of these spaces. What are some of the lessons that you've been able to learn from both of these different areas, and how have you been able to bring that experience with what do you think we could do now in terms of ensuring that these endogenous factors, we can ensure that we make our best use of them?
I've always said it doesn't matter which side of the equation you sit. The objectives are exactly the same. Grow the economy, make it sustainable, and make sure that you generate as many jobs as possible and reduce poverty. That's the nirvana. That's what we would want to achieve. Building a nation of independent people that are generally gainfully employed. If you do the reverse, it doesn't matter which side of the number line you're in, whether you're in the public sector or private sector. If you do the reverse, you're actually not investing for future generations. You're actually destroying the future of coming generations, or upcoming generations. So we all have an obligation to make sure that we build a better economy for future generations. One of the things that I have learned is that self-competence is extremely important. I've used trade as an example. In the times of GATT, General Agreement on Tariffs and Trade, the trade regime mimicked almost what we would call a competitive trade environment. And what that meant is that you grew on the basis of your absolute or competitive or comparative advantage. If you're naturally endowed with natural resources, you are likely to be strong in that area, and you're going to trade in those resources. If you've invested in your people and skilled them properly, they can be able to convert those natural resources into products and services that people actually need. if you don't have natural endowments, you have to try and focus on building your nation and educating and skilling your people. And people may think it's impossible. Hong Kong has done it. Singapore has done it with no natural resources, but look at how those countries are doing. They were run like serious businesses because they knew exactly what they wanted to get out of their policy combinations. So we moved from GATT to WTO. And what WTO did is it almost reduced the competitiveness in the global space where trade was negotiated. We're now in a very different environment where even if you're naturally endowed, you're no longer guaranteed of markets, because the way you trade is a function of what the counterparty wants. If the counterparty doesn't want to trade with you, that's it. You're not going to trade with them. So if we become more and more nationalistic as the global community, the likelihood is that we're going to grow more insular. And as we grow more insular, the possibility for growth is going to be limited, and the possibility for global growth even more limited. And this is why at the World Economic Forum, it was very important to elevate the importance of globalization and cooperation across the world. Whether we're going to achieve that or not is very difficult to say, but what it tells us is that counterparty risk has become a very important part of our risk management process going forward.
Elias, you said quite a bit there, and really a lot for us to certainly simmer and think about. I want to maybe bring it back to, again, those endogenous factors or things that we can do here in South Africa. And there was a recent survey that came out, I think Stanley put it together, around just how much cash corporate South Africa is sitting with on their balance sheet. I think it was to the tune of about 1.4 trillion, if I'm not mistaken. We know that we have this huge infrastructure gap. We know that there's obviously things that we need to be doing as a country and investing in our people, as you've mentioned. Why are we not seeing, those funds being plowed or invested into private and public partnerships? What is it that we need to unlock, or what is the bottleneck there? Again, drawing on the fact that you've been on both sides of the spectrum, so maybe you've got a bit of more vantage point to give us a sense of how do we get that money to actually start doing work for the rest of South Africa.
Look, I wouldn't worry too much about the amount of cash that businesses sit on. When we started this interview, I spoke about capital allocation. Very key. Even in the household, capital allocation is key. I would worry about, why do we have businesses sitting on cash? That says to me the incentive structures are wrong. We do not create the right incentives for people to invest into the long term. Instead, we are creating an environment that causes people to hoard their cash because of uncertainty. If they don't hoard their cash, they exit it out of the country to invest it in other parts of the world. So as a nation, we need to think about, how do we improve the environment by providing the right incentives? And I'm not even talking about tax incentives. I'm talking about creating the right policy environment for owners of capital to dig up capital into our grounds, not in foreign grounds. That for me is a fundamental challenge that we have to deal with as a country. One of the reasons that we are not growing sufficiently, we're not doing the fundamentals. When you look at one of the reports of the National Planning Commission, it recommends 3 key interventions for the country. And it argues that if you sort out these three areas, most of the other areas will resolve themselves. 1, invest in infrastructure, relevant infrastructure that's going to have a crowding in effect of the private sector. I don't think we're doing enough of that. Secondly, professionalizing the public service in order to increase the ability to provide better service and more services to society, which we have not done well over the past while. And hopefully, if you professionalize the public service, is that you may actually reduce the level of corruption in the country, because it would seem like, given the role of the state, it accounts for about 28 to 30% of the economy, GDP. Any wrongdoing that takes place in the public service has an almost 1/3 effect on the economy. If you do the right things, it will have a 1/3 impact in growing the economy. If you do the wrong things, it will have a 1/3 effect in reducing the growth of the economy. So that makes the public service extremely important. And probably thinking about what we've seen recently is that we may just have the ability to generate more research, have more professionals in the public service, being innovative about the policies that we put together to make sure that they intertwine easily with what the expectations are in the private sector. Thirdly is law and order. If you sort out law and order, criminals belong in a particular place. And if they all end up there, the likelihood is there'll be less criminals outside. And those that are remaining, the criminals that are remaining, will see the message and will change their ways. And the allocation of capital at the national level, or if we can talk about resources in general, resource allocation is going to be enhanced if you have less corruption and the right people are making decisions in the economy. So those three things, I think, are very key in turning around this economy.
Elias, you mentioned the importance of ensuring that we have the right environment, the right people who are making the decisions, and the importance of policy. Now, again, I suppose going back to the example of President Trump, we've seen him, or his stance when it comes to, the climate accord or diversity, equity, and inclusion. These are things that in South Africa we are, have taken on board and have adapted. But our ease of doing business and, things like affirmative action, for an example, haven't always been well received. I think my question is, are the things such as, diversity, equity, and inclusion just, I suppose, nice to haves? Are they just another hurdle for businesses that are just trying to thrive and play their role in the economy? If you've got President Trump who's saying that we don't necessarily need that, why are we pushing this agenda so much? What is the importance of going ahead with these types of policies?
I will not argue this academically. There is no doubt that diversification is important. Even as you think about where to invest, you'll always diversify. I think the people who argue that diversification is not important are probably talking from a position of privilege. I may be wrong, but I think I would like to leave that argument on the table. Now, if you and I were in pre-1994 in apartheid South Africa, in the 60s, 70s, I don't think that you and I would be in the positions that we're in today. That for me is the best illustration of how diversification is important. And it is extremely important that as you design policies, whether it's in government or the private sector, you design policies that are actually going to be conducive in the environment in which you operate. If you design policies that perpetuate income inequalities, I am not sure that that is a sustainable way of running any economy. So with that, with those two anecdotes that I've just made, I am not going to argue too much with the people who think that diversification is not important, empowerment is not important, I will allow them to think about the two examples that I put on the table.
You mentioned the importance again of ensuring that policies are, are beneficial, I suppose, another way to put it, for the development of the country. You've obviously spent some time at National Treasury. Not so long ago, we had our national budget. Happy to get your sense on where you think the country is going, looking at the GNU. Are you feeling quite confident or positive about the country? Just your sense on that.
I am not an emotional person, so I'm never optimistic or pessimistic about anything. I try to be objective. And one of the biggest benefits of the GNU, both intellectually and practically, is that it has allowed for different views around the table. The same thing we're talking about earlier on, diversification. And those different views bring into play checks and balances that were not there previously. And what that means is at every stage when you make a decision, you'll make it within a context that says, this is what I think is the right thing to do. What does the next person think? So checking your decisions on an ongoing basis is extremely important to make sure that you make an optimal decision. And I'm not saying it will be right. An optimal decision may be the wrong one, but all that you do is you try to optimize as much as you can on an ongoing basis, which you cannot do if you make decisions on your own. You end up with a lot of blind spots. You end up with a lot of arrogance because you think you know it all. And for me, the best decision maker is the one that consults.
Elias, thank you so much for your time. I think we leave it there for today, because I certainly know that we could carry on this conversation and ask you a lot more. But thank you for sharing your knowledge and your experience with us, and of course just taking us into your confidence and sharing those experiences. It's been invaluable. So thank you so much for your time.
Much appreciated. That's my pleasure. Thank you.
Thank you to all our speakers for their enlightening presentations, and of course you for joining us today. We hope that you have found the webinar both informative and engaging. If you have any feedback or questions for us, please do feel free to reach out to us. Have a great day, and we look forward to seeing you at our next event. It's goodbye.